Welcome back, focused learners. Ready for another explainer? Today we're tackling a topic that frankly causes a lot of folks a ton of unnecessary anxiety. Yep, we're talking about investing. But hey, don't worry, we are not going to be looking at complicated day trading strategies or chasing the next hot stock today. Instead, we're going to discover a surprisingly lazy, automated background process. We'll start at the ultimate psychological starting line, your first $10,000, and see exactly how to set up a system that literally makes your money work for you. To do this, we've broken the source material down into a really simple roadmap. For today's agenda, first, the silent wealth killer. Second, 3 major investing myths. Third, the 3-layer allocation system. Fourth, 5 execution steps. And finally, mindset and compound interest. Let's get right into it. Okay, section 1, the silent wealth killer. So, have you ever actually sat down and done the math? Think about it. You wake up, commute for an hour, work 8 long hours, commute an hour back home. You're spending at least 10 hours a day working for money. But how many hours is your money working for you? While you're out there working yourself to the bone, your money is probably just taking a long nap in a standard bank account, earning a microscopic 1% interest a year. You're grinding, right? But your money is completely passive and, honestly, unproductive. When you really think about it, it just doesn't seem fair, does it? And here's why letting that cash just sleep is actually pretty dangerous. Right now, in the US, inflation is hovering around 3.3%, but the national average yield for a 1-year fixed deposit, it's only about 1.9%. That means you are taking a net loss of 1.4% every single year. The source material compares this to carrying water up a mountain with a huge hole in the bottom of your bucket. Over 10 years, the actual purchasing power of your $10,000 shrinks down to just $8,700. Yikes. Moving on to section 2, 3 major investing myths. These are the deep-rooted excuses holding so many of us back. Myth number 1, saving is the safe route. Myth 2, you shouldn't even bother unless you have hundreds of thousands of dollars to play with. And myth 3, investing means you have to be glued to a screen doing endless chart research. Let's tear these down one by one. Here is the first major realization from our source material. Playing it so-called safe in a checking account, that is actually the most dangerous move you can make for your wealth. You are basically guaranteeing a loss of purchasing power as prices inevitably rise around you. Reality check number 2. You absolutely do not need massive capital to get going. $10,000 is the perfect starting line. Why? Because it's all about building the system. Think of it like going to the gym. You wouldn't refuse to exercise just because you only have 10-pound dumbbells, right? Getting that first $10,000 invested is what generates that magical first $50 a month in passive dividend income. It fundamentally shifts how you view your money. And reality check 3. Listen, your time as an everyday worker is way too valuable to spend day trading. Proper passive investing is just admitting that the broader market is smarter than you are. You shouldn't be staring at charts all day. Honestly, you should treat your portfolio exactly like a washing machine. You pick the cycle, hit start, and just walk away. Go focus on your family, get some rest, or level up your professional skills. All right, section 3. This is the big one, the 3-layer allocation system. Now, what's really interesting about this slide is how we take that intimidating $10,000 and just chunk it down into 3 distinct, highly purposeful buckets. We've got our safety net at 20%, our growth engine making up the bulk at 60%, and our opportunity bullets taking the final 20%. Let's look at exactly what each of these layers does. Layer 1 is your safety net. This $2,000 is absolutely not for the stock market. It goes straight into a high-yield checking account or a short-term fixed deposit. Now, you might be thinking, isn't keeping cash a waste? But actually, this provides your ultimate psychological security. If a pipe bursts or you lose your job, you won't panic. And more importantly, you won't be forced to sell your investments at a loss to cover it. It's the absolute key to maintaining a steady pace in this financial marathon. Next up, layer 2, the growth engine. This is where the core 60%, that's $6,000, goes to work for long-term steady growth. The strategy here splits that money 70-30. 70% goes into volatile broad market ETFs. Think Vanguard's VT, VOO, or VTI to capture those historic 8 to 10% returns. The remaining 30%, that goes into bond ETFs. Bonds offer slightly lower returns, around 3 to 5%, but they provide immense stability. Combining the two prevents those wild stomach-turning swings while still maintaining a very solid real return of 6 to 8%. Then we have the final layer, your opportunity bullets. You hold $2,000 in flexible cash, maybe in a money market fund earning a modest 2 to 3%, but its true purpose is ammunition. You only deploy this money when the broader market drops more than 15%. Holding this cash turns widespread market panic into a priceless psychological advantage for you. For instance, during the 2022 crash, deploying these bullets yielded an incredible 30% gain during the 2023 rebound. Talk about a game changer.
Okay, moving right along to section 4, 5 steps to execute.
Here is your exact to-do list. Step 1, open a zero-commission brokerage online. Seriously, it takes 10 minutes. Step 2, set up automatic monthly transfers. Look, human nature is fundamentally lazy, right? So let automation do the heavy lifting for you. Dollar cost average your entry by auto-investing $1,000 over 6 months to completely avoid market timing stress. Step 3, pick broad total market ETFs like VTI or VOO. Don't stress over finding the absolute best fund. Just get started. Step 4 is rebalancing. And step 5, keep up your financial education for an hour or two a month without obsessing over daily charts.
And this brilliantly illustrates step 4, rebalancing. Let's say your stocks grew way faster than your bonds over the course of a year, turning your nice 70-30 portfolio into an 80-20 split. Rebalancing just means you sell some of those stock winners and buy the bond losers to restore that original 70-30 ratio. I know, it sounds completely counterintuitive, but it actively forces you into the ultimate investing rule: sell high and buy low. A simple 30-minute task twice a year keeps the whole shebang fully optimized. Finally, section 5, mindset and compound interest. When we project this out over time, the math is just fascinating. If you invest that initial $10,000 at a 7% real return, in 30 years it becomes over $76,000. But here is the absolute kicker. If you simply automate an additional $200 a month into this exact same system, your 30-year total pushes past a staggering $300,000. No way, right? But it's true. Albert Einstein famously called compound interest the 8th wonder of the world. But to actually harness it, you've got to override your own emotions. You will hit bumps. During March 2020, portfolios dropped by over 30%. Looking at those paper losses is terrifying, but having a rigid, automated system helps you survive the journey so you don't panic sell at the absolute bottom. And while your portfolio's off growing in the background, we need to deliver a profound mindset shift about your lifetime earnings. If you're 30 years old, earning $60,000 a year, and you work until 65, you will make $2.1 million in sheer salary alone. That proves that while your investment portfolio is super important, your human capital, meaning upgrading your professional skills to earn a higher income, is actually your greatest asset of all. We've covered a lot of ground today, but the biggest takeaway is this. You have to stop waiting to feel 100% ready. You never will. The market always has risk. But guess what? Inflation isn't waiting for you to feel ready either. So, challenge yourself today. Spend just 30 minutes opening an account or auditing your assets to see what you can start with. Ultimately, taking control of that first $10,000 isn't just about building wealth. It's about shrinking your daily stress, growing your confidence, and building the absolute freedom to choose your own path. So focus, learners, the strategy is right in front of you. The system is laid out. Will you give yourself the power of choice? Thanks so much for joining us on this explainer, and we'll see you on the next one.